As of August 3, 2026, during early pre-market trading, NVIDIA stock is sitting at $200.71 per share, showing an intraday gain of nearly 2.9% above its previous trading session close of $195.04 on July 30th and settling right near the $200.75 mark recorded at the close on July 31, 2026. The immediate impulse for most retail traders watching their ticker screens is to assume that this bounce back above $200 signals an effortless return to all-time highs. However, when you look closely at the underlying market mechanics, the real story unfolding right now is far more nuanced than a simple green daily candle. While crowd expectation assumes that endless infrastructure demand will automatically translate into linear price expansion, the reality on the trading floor reveals a complex tug-of-war between institutional repositioning and macroeconomic headwinds. If you look at how retail investors are approaching this asset across popular retail trading apps like the Robinhood app, SoFi Invest, and Interactive Brokers trading accounts, you see a massive wave of retail accumulation. On the Robinhood stock trading interface, NVIDIA stock remains one of the most widely held assets through Robinhood fractional shares and core Robinhood investments. Casual retail accounts often view every single pullback as an automatic buying opportunity. Yet, if you sit down with institutional portfolio managers who utilize a professional individual brokerage or advanced platforms like the Interactive Brokers platform, the sentiment is far more calculated. The market consensus expected NVIDIA to seamlessly march back toward its 52-week peak near $236. The reality is that institutional desks are using rallies above the $200 mark to rebalance risk, manage position weights, and hedge against broader tech volatility. To understand why this gap between retail expectation and institutional reality exists, we have to look at recent price movement and trading volume. Over the past few trading sessions, volume has hovered around 139 million shares per session, which is slightly below the 3-month average of 152 million shares. High-volume up days signal aggressive institutional buying, whereas lower-volume recoveries suggest that the current price push is being driven largely by systematic retail flows and short covering, rather than fresh, heavy institutional capital allocation. Investors searching for investment help or researching options on various investing sites often miss these subtle volume shifts. When you trade through a Fidelity brokerage account or monitor execution flow on the Fidelity mobile app, watching order book depth shows significant resistance levels resting just above current prices. Many everyday traders who engage in self-investing or manage their own individual brokerage accounts look at tech giants side by side. They compare NVIDIA stock directly against Tesla stock and Apple stock when constructing a diversified portfolio. On platforms like SoFi Active Investing or when choosing self-directed options within SoFi stocks, NVIDIA is frequently paired alongside other high-beta market leaders. However, the operational dynamics driving NVIDIA are distinct from consumer hardware or electric vehicles. While Apple stock relies on consumer upgrade cycles and Tesla stock trades on production volume and autonomous driving promises, NVIDIA is fundamentally tied to enterprise data center capital expenditures. When major enterprise clients buy hardware, they purchase thousands of server racks at once, creating huge lumpiness in quarter-over-quarter revenue comparisons. This leads us directly into the fundamental engine behind the company. At its core, NVIDIA designs ultra-high-performance graphics processing units, enterprise networking hardware, and the software ecosystem known as CUDA. Rather than manufacturing its own chips, NVIDIA operates a fabless business model, partnering with giant semiconductor foundries to fabricate silicon while concentrating its own internal resources on architectural design, software optimization, and system integration. Past financial reporting cycles yielded unprecedented gross margins exceeding 70%, allowing net income to surge in tandem with massive data center demand. Past earnings reports showed record-setting revenue growth as hyperscalers scrambled to build out processing clusters. However, the expectation built into the stock price today assumes those sky-high gross margins and hyper-growth rates can continue indefinitely without facing supply chain constraints, competition, or margin compression. The reality confronting the company as we move through 2026 is that enterprise buyers are scrutinizing their return on invested capital much more closely. Corporate clients are actively asking whether their massive capital expenditures on hardware are generating immediate monetizable software revenue. When enterprise software companies report earnings, any hint of slower revenue conversion creates a direct ripple effect back to chip designers. This is why institutional wealth managers, whether operating through Fidelity Wealth Management, Schwab Intelligent Portfolios, or an automated intelligent portfolio, are taking a more cautious stance on valuation multiples. From a macroeconomic perspective, interest rate policy and global semiconductor trade dynamics continue to weigh on the broader market landscape. High interest rates raise the cost of capital for cloud providers planning multi-billion-dollar data center builds. Furthermore, export restrictions and regulatory hurdles continuously shift the addressable market in international regions. Investors utilizing online investing strategies via SoFi Robo-Advisor or low-cost accounts on SoFi Investing must recognize that external policy decisions can alter revenue trajectories just as quickly as product innovation can. Even with low interactive brokers' fees making international trading seamless for global participants, regulatory boundaries remain a hard constraint on where advanced hardware can be legally shipped. Comment below how many shares of NVIDIA stock you currently hold in your portfolio and whether you are buying, holding, or selling at current price levels. When evaluating potential catalysts over the coming quarters, the focus centers on next-generation hardware architecture rollouts and software monetization. If NVIDIA successfully scales production of its Blackwell and follow-on architecture systems while maintaining pricing power, revenue estimates could rise again. A major upside scenario involves enterprise clients accelerating custom software deployment, proving that hardware investments yield clear corporate productivity gains. Under that positive scenario, the stock could break past previous overhead resistance and test new watermarks. Conversely, a downside risk scenario involves hyperscalers taking a temporary digest period in their capital budgets, or custom in-house silicon from big cloud platforms capturing a larger share of internal workloads. If major cloud platforms rely more heavily on their own internal custom processors, NVIDIA could face pressure on its premium pricing structure. For investors who prefer a structured online investment framework, balancing high-growth chip stocks with broader market funds is often the preferred strategy. Many long-term retirement accounts held within Fidelity IRAs or managed through Fidelity ETFs and Fidelity mutual funds keep core positions in index funds while using a secondary Fidelity trading platform or Robinhood stock trading account for direct equity picks. Similarly, users taking advantage of Robinhood Cash Management or Robinhood Crypto often split their speculative funds from their long-term core wealth. Whether you conduct your trading on the SoFi trading platform, manage an interactive broker's account for advanced option strategies, or rely on Invest Online tools to automate monthly contributions, understanding the difference between market hype and structural business reality is essential for long-term survival in direct equity trading. The contrast between expectation and reality remains the defining theme for NVIDIA stock right now. The prevailing public narrative expects an uninterrupted upward trajectory driven purely by hype surrounding advanced computing technology. The grounded financial reality shows a dominant market leader navigating elevated valuation expectations, evolving customer budget cycles, and increasing competition from custom internal silicon. Current price action near $200 per share reflects a market trying to price in both immense long-term secular growth and near-term structural hurdles. By looking beyond simple daily price movements and analyzing volume dynamics, capital expenditure trends, and gross margin durability, investors can make direct, clear, and informed decisions across any brokerage platform they choose to use. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Don't forget to like, comment, and share this video